everyone. This is the Investors Guide to Joy podcast, and my name is Paul Graham. Today, we are going to talk through the secondaries market to give you an opportunity as an investor to ultimately see how best you can change the types of investments that you initially make. When you make a private placement into these various investment and fund strategies, your equity tends to be locked for 3 to 5 years or whatever the PPM says that it's going to be. Christion and his company give a new innovative way for you to ultimately unlock that equity with the opportunity to have upside. It's a fascinating concept that I believe will be transformational to the industry, not only to the general partners, but also to the limited partners who are looking to extract that equity. We talk through the investor scenario and as a fundraiser, what you should consider in the process to ultimately see when, how, or if this would be a valuable strategy if you've already made investments in private placements and are looking to sell on the secondary market, or maybe you're looking to purchase secondary market type funds that are being offered from limited partners. If you are looking to offset your taxes for 2024, consider investing in oil and gas. It's going to have more appreciation than real estate and give you passive cash flow to ultimately offset the most amount of taxes and give you the most upside for that investment. More information will be linked in the show notes for you to inquire about. And now let's get into the show. Today, everyone, we're going to meet with Christion, who's going to go through his company, or the company he's the CEO of Pre-iShare, really helping investors on the secondary market. So this is transformative as you are a non-accredited, but mainly more of an accredited investor who has invested in some sort of, syndication, and you're looking to potentially sell for some sort of equity play, as well as an individual who then wants to get in this game. So we'll talk about, the different process, the opportunity for it, and really how you and your team are really seeing the market, because I believe it's just an absolutely different way to view what's happening and, both in kind of the macro and in like the syndication space. That's different than just the everyday investor, as well as the capital raiser. My opinion from the capital raising side is like it's always a great time to buy and invest, right? Kind of like a real estate agent in a way. And, this really gives that opportunity for really going through seasons. So Christion, thanks so much for being on and sharing your insights here.
Absolutely. Thanks for having me.
Yeah, no, you bet. And this is a fascinating thought because, one initial thought that's coming to mind, and then I want to give you a, opportunity to give an introduction of kind of what this is and how this is like, are you seeing more of like first time type of investors in syndications that are, exploring this secondary market in terms of like selling, or is this more kind of the seasoned people that maybe just were a little too lofty with their thought of returns and they're just looking to sell kind of one of their pieces? Like, who are really trying to define like, who is this typically and like, who is this for? And then also go into like, who's this not for? Like, stop listening or like just be curious, but like don't go down this path.
Sure. Yeah. So this is really, there's a mix when you talk about how long these people have been investing, right? You do have some of the newer folks that maybe they've invested in a few syndications and they got into, with just the limited knowledge that they had. And then they started realizing, holy cow, there's all these opportunities that have so much better returns. I may be better off liquidating what I have now, even though it's a solid investment, so that I can upgrade to another investment. But I think probably the most use case of the secondaries market is really when a life situation comes up. And of course, we all have those, right? We never know when it's going to happen. So whether it's a kid getting to college, whether it's a medical emergency that comes up, whether all of a sudden we need to buy a house, we're seeing divorce situations where all of a sudden somebody needs the liquidity to handle the divorce. And then one thing that we're not seeing yet, but I think we'll be seeing more of is probate situations. Quite frankly, some of these people that are investing passively, if they pass away, there hasn't really been an opportunity for their heirs to get access to the liquidity from those investments. And sometimes that can be a long-term contention point. So this would be an opportunity to find that liquidity.
Okay. Yeah. So would you say it's seeming like more on the life situation than just the investor type play, like kind of like 60-40, 80-20 sort of thing? Or what have you really found?
Well, I think they say 80% of statistics are made up, so I can make one up for you. But I would say it's probably 60% life event and 40% they're just looking to switch out what type of investment, that they're in, really.
Yeah. Certainly. Yeah. Because by all means, certainly they would do the right underwriting to then get into the right deal that they then most likely is not going to be. But certainly I've had deals across my desk. I had the opportunity to buy an oil and gas company, I don't know, call it like 3 weeks ago. We needed a $2.5 million kind of amount of funds to be, have really for a 6-month interest only. And then that could be converted into like operationalizing the company, meaning to say like, some funds I put into other places would radically be different, right? Especially if we could double the net profit of that company. It could buy a boat and a, truck to pull it and every single thing, right? And so sometimes those deals come out of different situations or different market cycles or things like that. And so now that people are really thinking on, or go ahead if you had a comment on that.
Yeah, I was just going to interrupt there because as you bring that up, it brings to mind some of the scenarios that we are dealing with that actually are GPs that are finding liquidity for other opportunities. So GPs may have an LP interest because either they didn't raise all the capital and they put in money themselves, or they just felt so good about the deal they took some additional LP equity. And we are finding those where they're staying in the deal, but they're liquidating some of their passive interests so that they can take advantage of another opportunity. So we do see a fair amount of that as well.
Yeah, that's an important thing, to highlight. And we're, having conversations about, doing additional podcasts here. But I do want to take a quick moment to simply say that, like, I have talked to the, GPs of the world, if you will, not necessarily some that are at, the 100 million plus type AUM, because they traditionally have enough, cash flow and savings equity type piece to like kind of live their lifestyle. But those that are like newer-ish or like had the W-2, got into the syndication space, had some deals, left W-2, life's real gravy until it's not. And they're really, one specific example, an individual that was going to have about 180K payout in like 2.5 years. But, more or less this year was just chomping at the bit and was like, hey, like we might kind of force the sale a little bit or kind of convince some people to do the sale simply to like get liquidity out because they just were trying to figure out how to make, 10 grand a month just to simply survive. And it's that idea of like the marshmallows, like so far down the road where if you have one and you wait and then you get two at the end, like, oh, I'll wait all day. And it's like, well, you got to eat to get there. Right. And so I've seen that at least from, some people that I know. So it's an important thing to call it and to give an option if, they truly are, an LP with it, they can. So I'd love to just give you here a moment, like describe more of like, what this is, maybe even some background around it. Really just as we go through these questions, we can get a good grasp of like what we're talking about, what it is, as well as what the opportunities are, considering we just went through like a number of the different situations.
Sure. Yeah. And let's clarify that we're talking about real estate secondaries. And so there's a secondaries market in almost every other asset class. And for some reason in real estate, it really hasn't been established. And so the way that I got into it, I was actually pulled into it by Michael Anderson. And Michael Anderson was a longtime real estate syndicator. He's been syndicating real estate longer than I've been alive, so over 40 years. And started in retail and then built a company called Real Source. And Real Source did multifamily value add transactions. They did about $7.5 billion worth of deal flow and regularly held about $1 billion in assets under management. And that industry treated him very well. And he decided to retire and he sold his company to his business partner. And as he puts it, he retired for all of about a half a cigar before he started thinking about new business ideas and things that he wished he could change about the industry. And he's very much an entrepreneur. I'm very, sharp individual. And so he really started thinking about all of the situations that had come up, whether it was, one of his track buddies that was on the list for the new Ferrari, or whether it was an investor that called because their wife had cancer and insurance wasn't covering it, or he talks about where oftentimes he would have these long conversations with investors before they invested, and they would explain to him, I'm putting this money to work so I can pay for, in some scenarios, kids' college, right? And then 3 years later, hey, guess what? Kid got into Ivy League school and they got in earlier than expected. I need that liquidity. It was really tough for Mike to say no in any of those situations. And so that put the pressure on him. As you know, and as you talked about, many GPs, they have to scale before they're really making any type of real, wealth for themselves. Most of their wealth ends up held in these projects and these properties until there's some sort of an exit. And, so he just thought, why isn't there a more simple way? And he started talking to other people in the industry, people that he was friends with along the way. And it really spanned from when there didn't used to be 506C, which is fairly recent. What was that, 2012 or whatever, when they made those changes and updated the ability to take in, people that were not already an established relationship with you. And so back when it was only 506B, you had to have that pre-established relationship. And so they wrote that into all of the documents. And still many people are today that says, if you invest with me passively, and you need out earlier than there is an exit on the deal itself, the transaction itself, then you have to sell it back to me first. And if I don't want to buy it, then I may give you the opportunity to sell it to somebody else that's already a part of the transaction. And it really puts people in a tough spot where how can you realize any of your equity? How can you get a true fair market value if you're negotiating with people that invested with you in the first place originally, and their, perception of value is where you started, even if they're the ones who have taken and doubled the value of that investment over the last couple of years. And so by having a marketplace where people could list those, which is what Pre-iShare has created, is a listing hub. A website where you can go list your shares in an existing transaction, find a buyer, and then get approval from your sponsor to sign off on slotting that new accredited investor into their transaction. And so that's the core concept of it. I'll stop there, and then we can jump into any other questions that you have.
Yeah, no, great. So I, at one point, just to share a story, went down the path of Marriott Vacation Club, right? And, found out that there was a secondaries market for that. So I said, hey, thanks so much for your time. Like, I'm going to explore this. I didn't end up pulling that trigger there, but it really gave this idea on that there is the secondary market. And in a lot of ways, it's kind of like a used couches, used, again, all these things, right? But there really hasn't been one for real estate. So it gives this incredible, power and opportunity. One thing that, I thought of with the Marriott Vacation Club sort of aspect is are these legitimate and vetted and things like that in the age of just the virtual real estate, if you will, right? And sometimes there's that sort of concern. So I'd love for you to also talk about kind of the compliance or any underwriting or concept that people have, and kind of reassurance for people to understand these are exist in some aspect, or if at the very least it's just the contact information is, and they need to do their own due diligence, which they certainly should regardless and need to. But curious where your platform kind of starts and stops with that sort of validation and consideration.
Yeah, so we emphasize very much on doing your own due diligence. Make sure you're understanding who you're dealing with, the overall project itself, because we are buyers on the marketplace as well, right? So the Pre-iShare liquidity fund will buy these secondaries and create some instant liquidity. So there's a lot of due diligence that we will do on assets that we're looking to buy, but we don't go on to get into the aspect of doing any sort of recommendations for others or, the due diligence on their behalf, because as of, the platform, we don't control any of those transactions. We don't take any, promote on the sales or anything else. It's just a flat fee listing service, really a classified site where people can list and then find a buyer, and then ultimately, go do your due diligence. So if you're a buyer on there, you really want to come in there as a sophisticated investor, understanding how to verify that the person owns the shares, the GP owns the real estate, and that you're buying something tangible and real.
Yeah, certainly. So talk to me more about what that's like, right? So I see something that's offered at a certain price point, certain deal, things like that. Is it negotiable? Who's setting that value? How would I even go about underwriting that piece of ownership that's on the secondary market?
Yeah, great question. And really, a lot of times the first question that comes up is, sure, you can sell these things, but what discount do you have to take? And sometimes there's just this automatic perception that if you're selling it, you're going to have to take a discount, when the reality is it's an asset. And how good you are at selling it is where you can price it. So we don't control any pricing. We don't suggest any pricing. It really comes down to, you have this asset and it has value of some sort. Otherwise, you probably, wouldn't be trying to sell it. So you determine what that value is, and then that person who's buying it is going to negotiate, and they're going to determine what their value is. And what you'll find is there's a lot of different types of investors out there. So some investors really highly value the amount of current cash flow that's coming from an asset. Others are going to really value what is the upside equity, right? And so, when it comes down to it, you want to price it appropriately to find the buyer that is looking for that asset in the stage that it's in with its current investment cycle.
Yeah. Okay. Yeah. I mean, that's an interesting piece to think about and evaluate and understand. It's definitely a buyer beware sort of use case. what sort of like talk us through the experience, right? Because when I go to sell maybe an investment property, I talk to a real estate agent and it's, hey, days on market are 60 days, typically takes 32 days to close, and here's the kind of concessions, or it's a buyer's market, or all that kind of stuff. Like, what sort of timeline are we looking at? What sort of logistics? What sort of concerns? And what like additional costs? My viewpoint is that I'm totally going to give this to my lawyer, right, to review the PPM, to review some of these things, and what's going to happen. And are we doing like a side agreement with the individual? Like, we can go through that like kind of legal pieces as you may know into it, but just like kind of timeline and tactical costs in addition to that, asset. What does that look like?
Yeah. And I will say that because we are so new to the market, there's not a lot of data that we can run off of. I am excited for the time that we have all of that data and we can talk about the different types of assets and what they're trading at, as opposed to their current value and timelines and things of that nature. But it's easier if I just explain the process. So you have a share in an existing asset, and maybe that share has equity and also has cash flow. So you're going to go and you're going to make a listing on the listing hub. Now you have this assets that's up there for sale. And maybe you invested $100,000 in, and I'm just throwing random numbers out there, but you believe it's worth $250,000 currently, plus it's paying you, 8%. So you go list it at $200,000, right? Now it's about finding somebody that can see that value and say, okay, I see the equity multiple and I'm still getting a roughly 4% return on my money right now. I want to buy that. Well, you now need to get the sponsor involved. The sponsor always has to sign off on any trade of a secondary, because ultimately they're the ones that take the liability of what investors are involved in the transaction. So they're still going to need to verify, if this is a 506C, for example, that these are accredited investors. Now, there's a lot of third-party services. It's real easy to do that these days, but you do get sign off from the sponsor. Now, many sponsors, and what we're finding is this has been adopted by the sponsors at an even higher frequency than the investors, surprisingly, because many of the sponsors say, when they really think about it, they say, okay, I've got an investor that wants out of my deal for one reason or another. I have somebody else, a brand new accredited investor that I didn't have to go advertise for. I didn't have to go to an event to meet. They just are brought to me, served on a silver platter, that wants to be in my deal. And all I have to do is sign off on and, do the basic due diligence on allowing them in. Most sponsors are really in for that. And when you figure out how this helps to align those interests, I think there's a real benefit there. So, that's kind of the big aspect. Now, some sponsors will say, hey, listen, there's some legal fees involved in this. And we've noticed, like, for some of the bigger sponsors, and I won't name any names, but there's some, big names out there that have, thousands or tens of thousands of investors. And so some of those people are now looking for liquidity. And those guys already have processes in place. It's going to be this much in legal fees. We only make the transfer, at the end of a quarter, some of those rules and whatnot in place. And so if it's a smaller sponsor, they may not have any of that in place, and they may not require any sort of fee. But that's the only potentially added fees that I would say are going to be there, as the sponsor may tack on some fees, and there may be some legal fees on your end to make sure you're doing things properly.
Yeah. That's so fascinating to think about. And are those things you're mentioning like would be in the PPM, or where would those kind of details of like buying and selling be located?
Yeah, no, typically as of right now, because it's not widely adopted, not a lot of people have those, like built in to tell people how to do it. They just have it as internal processes. So it's about reaching out to the sponsor. And so I would say, if you are an LP and you're looking to sell your shares, it's a good idea that as you're building the listing, to reach out to your sponsor and just ask them the questions. I want to go find a buyer that can buy my shares. Will you allow me to do that? And if so, what are the processes? Is there anything that you're going to require above and beyond verifying this investor that's buying in?
Yeah, certainly. And it's definitely the, again, idea being on the secondary market to then say, like, as it's foreseen as valuable, then people like would invest in it. Meaning to say, if a project's going, down the drain, then, certainly its value's decreasing. And through due diligence, it's then, understanding that and what have you. What, ability does your platform give to talk to like the sponsor beyond just the, investor? Because obviously the sponsor needs to vet them. But what I'm curious about specifically is that as someone who wants to do like thorough due diligence, like I want to be able to connect and do all the things. And I might want to talk to everyone on the syndication team, right? Maybe be, a little annoying, not myself. I think that's a little egregious in some aspects, but at the same time, potentially, like I don't want to do a secondary piece and lose the change because I didn't do enough due diligence to figure out, hey, this, thing's going down the tube. So I'm curious, beyond just what the sponsor is giving, this new potential investor, what kind of, resources or maybe information, do you give, the investor who's looking into the sponsor and into the project?
And again, we're really not giving anything, right? Because we're simply a classified site, but we do suggest you get that information. One of the things that we do have is we have pre-iShare approved sponsors, and these are sponsors that essentially raise their hand and say, we want to offer this liquidity, and they allow us to do some due diligence on them. By no means do we tell the buyers to rely on that as a go ahead. But what we do there is we look at the background checks on all the primaries of we look at the track record, look at some basic information. We have an internal algorithm that we'll look at, including their reporting procedures and those types of things. And then if they can meet a minimum score, we will allow them to be pre-iShare approved. And at that point, we actually give them extra promotion. So we'll bring them onto our podcast, for example, and offer them additional exposure. But those people are going to be probably a lot more receptive to a conversation if you come in trying to buy a secondary that's inside their investor or investment. But I think you'll find that a lot of others will be open to it as well. And kind of it comes down to how much are they focused on taking care of their current investor pool. And most good sponsors out there want to keep their investor pool happy.
Yeah, certainly. Especially when it provides, optionality to, especially these life events of things that, they weren't necessarily, prepared for. And certainly if you're trying to, liquidate and, leverage into other deals, there's not as much of an emotional tie and kind of a hit to the ego. What do you mean you have a better deal than the one I have? But again, up to, the GP to then have this for the LPs, like, you mentioned, and then certainly as, those conversations can happen for the LPs and others to conversate about I guess, and this is maybe kind of skipping around your platform or something, but like if someone wanted to get in some sort of fund, that was closed, like, do you find that, I guess, what would the question be? Like, I can't think of, go ahead if something comes up.
Yeah, I think I know where you're going with this. And this is what I see as being a real benefit to the secondary market is kind of like private equity. You have what's called a vintage, right? So you might get it at a 1994 vintage that was a closed, scenario. And if you can buy it on the secondary, then all of a sudden you're getting those types of returns. And I think we're going to find that same thing in real estate, because oftentimes in real estate, when a sponsor starts, they give up a lot more equity in the beginning to the passive investor in order to attract an investor pool, right? And so if you can go get into let's call it a 2020 vintage where they were offering 80% to their passive investors versus 70%. And they also, potentially in that 2020 vintage, had 3.5% interest. I mean, you think about just that alone, the fact of now having ownership in this property that has interest at half the cost of what it is today leaves you some substantial additional upside just from the pay down of that loan over the next 3 years, 5 years, or whatever that time frame is. And so there's benefits, that way as well, especially if those GPs got fixed rate debt and whatnot, throughout that. So just thinking of it from that standpoint, I think might have been where your thought was going, is you can buy into these old vintages and get the upside benefit for doing so.
Yeah, it almost reminds me in some ways of like wholesaling with real estate, where it's like, hey, like, who do you know that has a problem? This is the platform, I leverage, or the concept of it, would you be open to it? And it's like, whoa, I've never heard this before as a GP. Yeah, I actually just talked to an investor the other day. Maybe this is, an opportunity. And almost making me think of find a list of GPs, send them an email, and, maybe get some discounted, opportunities. But again, to your point, it's not a guarantee that it's a discount. It's really dependent on, the situation that they're, going through and their willingness to sell, not necessarily the market value and market price, because they're, kind of being forced, whether it's their own forcing or maybe other life events that are forcing them, to do that sort of transaction, which is a interesting perspective I wasn't initially thinking about. And it's good to then, know. And so you've mentioned this is for real estate. Talk to me more about that, right? Is this residential, or could it be residential, but it has to be a fund? Is it, all types of different commercial, right? Multifamily, self-storage, all these sort of things. Could it be something like a debt fund? Could it be oil and gas? Like, I'm not going to go into the art and the other alternative investments because I'm not as familiar, but from the sense of like single family, general commercial, debt, and oil and gas, like what is this for and what is this not for right now?
Yeah. So as of right now, we keep it strictly to real estate, and it's typically going to be either a equity in a syndication or a fund, or it's going to be first position lien debt. So those are the two things, I guess three things, but kind of the two main categories on our website that you can access as far as secondary. And then we're trying to stick with real estate, but as we've now ventured into helping others find accredited investor leads for raising capital, we have all these other asset classes coming to us and potentially wanting to be on our site. So I don't think it'll be on the current listing hub, but maybe a future secondary website, or we just partner with somebody that already has that, because there's plenty of companies that have all alternative assets but don't really have a real estate focus. So to answer your question more concisely, it's real estate only, and it's got to be equity. It's not like you're putting, your home equity or, selling a single family home on there. It's an equity position that's passive.
Yeah, sure. Okay. Yeah. And it's fascinating to think about as you're going through this kind of wealth creation, like, again, having that opportunity, and certainly real estate I found is like the best way to like scale that, unless you're somehow, get into a PE type deal and, that takes off, but that's, few and far between I've often seen. So we talked a little bit about the process and, what it takes, what it is, what it's not, what does that mean in terms of like the benefits, right? So let's think of, taxes, ongoing depreciation, things of that nature. If I were to buy something in year one and I took, the depreciation for, whatever that deal was, then I then own that. Year, 2 or year 4, whatever it is, I then, look to sell. What does that mean in terms of that, year one? Or, is everything negotiable? Could I, because then you're gonna have to amend taxes and that kind of stuff. So, I guess really it's to say like, how many like levers and negotiating points do people have in terms of buying? Or is it, kind of like cut clean where, for example, depreciation can't transfer or cash flow can't, or, some sort of factors that we wouldn't think about? Because otherwise we would just look at the PowerPoint deck and the PPM. It's just like, oh, great, I get exactly that. Or I want that, but 20% discount. But there could be other things that we, may not be aware of that, again, may not transfer fully or partially, or what does that look like?
Yeah, and I'm not well versed enough on the tax side to know what you could do retroactively. What I do understand for the most part, again, talk to your tax professional, is once you buy that secondary, then you're going to get the depreciation moving forward. So if there's still some of that front loaded depreciation, you may get some of that. You may just get some of the, traditional depreciation that's ongoing. As far as what can be negotiated there, I'm not sure. But we have seen some creative situations even from our own fund as we're negotiating with folks where they say, I don't necessarily want to take that offer because it's not quite the amount of capital that I want. And I really think the backside value is, so much higher. And, we can turn around and negotiate and say, okay, well, how about you take that offer, but we'll give you a portion of the backside, almost like a coupon, that when there's an exit, if you really believe that there's so much more value there, then we can give you a certain segment of that. Obviously, you got to write that up in detail and figure out who's, taking care of that, the accounting side of that. With our fund, of course, we have a controller that can, segment out and make sure that that's all tracked properly. But, there is some creativity that way where if, they think that there's more equity on the back end, but you only want to offer them a certain amount of cash now, you can take over the current cash flow, but offer them some of that backside equity.
Yeah, that's an incredible, thought to think about, and how that negotiation plays. That's certainly going to be a conversation with a lawyer to draft, what that looks like. And I'm not sure what documents that would be, or if you would then be selling a security almost back to the investor, and something that's, out of my purview. But from my viewpoint of real estate, was a former commercial real estate broker. It's the idea like everything's negotiable unless, it's just the idea like everything's negotiable. It's just, what is possible on it. So I guess to say in another way, like, are you familiar or have you seen like what sort of legal pieces or parts like people need to consider and talk to their lawyer about with the like coupon piece? Like, is that another PPM? Is that considered a security? Like what sort of things come up that you found from what you know? Because a lot of this is relatively new as people, realize that this is possible. And then as creativity increases, even more so.
Yeah. No, it's a great question. And for us, honestly, on that scenario, we ended up first offering it, and it was just going to be a side agreement with us, where essentially on our accounting side, it would get paid out on the back end from us to them, right? But we ended up renegotiating that anyways, where they decided to just take a little bit higher cash amount and make it a little bit more of a clean transaction. So I think there's a lot to think about there. Definitely get your lawyers involved. Definitely make sure that there's, some accountability in that. And I don't know if that includes, you now need to write some sort of a PPM back to them that guarantees that amount.
Sure. Yeah. Well, certainly for, yourself or anyone listening, if you encountered that, reach out to Christian and I and let us know. Be curious to understand, because in a lot of ways it's new charted territory. And I'm just of the belief that this is going to continue to grow and expand into what, Subject to in a lot of ways has created, where, it's just the creative financing sort of piece. It's almost like creative selling, creative buying, if you will, which is really exciting for me, because I've really found, for my wealth journey, that investing in these sort of pieces or just real estate in general has really given an opportunity to leverage beyond, what I could, make just through hard work, and really give the opportunity for the experts to really do their thing, as well as find deals. In this case, deal being, hey, like some, life event, or again, a GP that has some LP interest, or, other situations that then give me an opportunity to come in that maybe I otherwise wasn't going to be able to. Again, timeline, equity stake, initial cash, something like that is important. So I'm really excited, for this. What would you say is the fit or kind of process for the secondary market? And specifically what I'm asking is, if something was, and is still, say, a 506B, and I'm accredited, does that mean, I could purchase? There really shouldn't be any friction there, right? But like, are there scenarios between like non-accredited and accredited investor versus fund, or, secondary market type piece that are like showstoppers, or maybe just concerned? Or certainly you can't, be non-accredited and get into accredited fund. So yeah, curious if there's other maybe restrictions that you've seen so far.
I think it's mainly what you're saying is you just need to make sure if it's an accredited fund, then you need to take somebody that is accredited. So if somebody comes in and makes an offer, it's ultimately going to be on the sponsor. But if you're going to bring them somebody, it's probably smart to bring them somebody that can fit into their transaction. So that's where the communication really, comes early if possible, because quite frankly, on a lot of 506Bs, they also have a certain amount of non-accredited investors that you can take, right? So they may not be full on that 35 accredited investors. And if you've got somebody that, the sponsor, and you know this from the fact that you also talk to a lot of capital raisers, they look at the long-term vision of this. So if they get somebody that right now is, liquid and wants to be involved in them and invested in their deal, and they can see some additional upside, that person is likely, if things go well, to invest over and over with them. And that's what we're always looking to do, is build out our investor pool of people that are loyal to us, that like being involved in our transactions. And why would we put a barrier in there if there's, not a legal barrier to do so? But definitely, you got to verify, does this person have to be accredited, not accredited? And typically, I think in equity, it's just easier to go for accredited investors. We actually have it, a disclaimer on the site when you register that says, in order to transact equity, you'll need to be an accredited investor, because that, clarifies that.
Yeah, you bet. And the best way I've found to understand if you're accredited investor is work with your CPA to go through that process, get that letter. By all means, you can use Excel spreadsheets to assume you are right. But there's a difference between actually being and having that certification. And I would also assume that would make the process easier as well. And certainly it's easier to have that transactional piece if you are accredited, just because there's additional hoops that you've already jumped through essentially. And because you don't have that relationship initially, I would also think you may not be able to be non-accredited and get in a non-accredited fund. But in a lot of ways, this is kind of learning as things are growing. When we because we talked a couple times at this point, you're now the CEO of the company. I've shared my sentiment of like, hey, this is great and amazing, and I'm so excited. Is this Bitcoin? Is this NFTs or virtual real estate? Like, I'm not going to put that comparison because it's its own unique thing. Where do you see this going? Is this going to radically like flip the entire primary industry on its head? Is this just an impact of like 1% or 20% or 80% of the market sort of thing? Certainly there's like the vision of maybe all of it, right? Everyone wants all of it, but like, where do you see realistically, let's call it in 1 year, 5 years, and like 5 decades of sorts, you see this, or does it even change over time? What comes to mind for you?
Well, and I wish I knew the timeline of when this really gets adopted, because I do think that it's going to make for a better marketplace in real estate syndication as a whole. I think there's benefits for both sides. There's benefits for the people that need the liquidity. There's benefits for the syndicators as well. And, again, Michael Anderson, our founder, talks a lot about this of as a real estate syndicator, if you're building a large organization, if you've got $1 billion in assets under management, there's a lot of additional value you have from holding on to that property long term, potentially forever. But it's built in, if you're running it as a syndication, that your interests aren't aligned with your investors in that scenario, right? Yeah. They want to see an exit. So with a secondary marketplace, there's the potential for you to build your long-term vision where you hold these properties forever. So you're getting the ancillary income on having the property management in-house and having the asset management in-house and, all of those different things there. So I really think it's going to help the market as a whole. It actually will probably bring down the cost of equity in some cases as well, because up until now, when you're out there, pitching a passive investor, you're going to have 7 out of 10 of them that want to be in your deal because they like real estate, they like your vision for it, but they just don't know that they can, hold out for 3 years or 5 years. They don't know what life events are coming out. And that's what oftentimes holds people back from investing in real estate when they would much rather be there than in other asset classes, for example. So if they now know there is a liquidity option out there, then they're going to be more likely to invest. And the reason that we offer such phenomenal returns oftentimes in real estate is because we have to overcome that lack of liquidity. So overall, I know I'm not giving you specific timelines because quite frankly, I thought it would have been adopted a lot faster even by now. And maybe that's just the optimist in me. But also from the investor standpoint, if I can switch topics a little bit, because we just haven't hit on it yet, the reason that we have our fund, the Pre-iShare Liquidity Fund, to buy these secondaries is the benefits that I think many buyers should be thinking about. You can buy late stage. So that means that you're going to be quicker to an exit, right? You can evaluate the deal based on its performance versus pro forma, right? Typically, when you invest in real estate, you're looking at what they hope it can do. But if you can look at the last 2 years' history before making a decision to buy, that really gives you some potential upside that way. So, there's some major benefits as a buyer when you look at these. And then if you can also potentially negotiate yourself a discount and you can have immediate cash flow on something that maybe was a value add or even development deal, but you're buying in late enough that you're getting immediate income plus some upside. That's where I really think that this is going to create a new asset class where people are going to be very strategic in it. And there's other folks that may be really good at picking good sponsors and negotiating good terms on the front end. So they may go in and negotiate great terms, invest their capital, hold that until the value has gone up significantly, and then turn around and sell that to a more patient investor or an investor that has, a less of a risk tolerance and wants to see some stability with that transaction. And there can be some additional trading that there just really hasn't been in these passive real estate assets.
Yeah, certainly. So conceptualize that more for me, right? So iShares like has an actual fund that investors could invest in directly?
Oh, yes. So we do have a fund. And what we're doing is we're buying these secondaries at scale.
Awesome.
right? So we're buying with immediate income plus upside, and that's pretty phenomenal.
Yeah. And is that for non-accredited, accredited? Does it depend?
506C, so it is accredited investors only. Yep.
Awesome. And what sort of minimums are you seeing, or is it a set amount? I'm not sure if there are multiple funds or.
Yeah, as of right now, we just have the liquidity fund, and currently we're early stage, so we are allowing investors to come in with as little as $50,000 in capital. That will be higher in the future, but as of right now, like I said, we're just kind of priming things, and we're very early stage.
Yeah. Okay, awesome. Yeah, that's great to know as well. For those that are interested in the secondary market, but who may not be wanting or willing to do kind of that due diligence piece of that evaluation, but certainly kind of following along the wave, that you're creating, and then also, purchasing as well. So yeah, I mean, this is incredible and something I'm really excited about, because it's just like you said, it's buying something that's performing, not necessarily pro forma, because every single syndicator in the world just is like, oh, yep, and it's just going to go 3% up every single year for 5 years, and then we're going to sell it, right? And the analyst in me is just like, malarkey. No, what about, different, election event or all these kind of things. And those things are also tough to predict of how is that going to impact, right? We think there's going to be some sort of downturn in the next, 5 years during this property. Is that how much is that going to offset? And you don't want to give too much information, if you will, to the investor, because then they're going to think more about it and then, be kind of in a state of paralysis almost. But for me, at least, underwriting, you darn tootin', I'm going to go through that. And that's something we go through, our deals within oil and gas, and I've also done within commercial is great. The population growth is a ton right now. When do we reasonably expect it to stop or things to change or things like that? And where is it going to then stabilize or potentially dip? Because that's really where you see that equity play come into is it's great if it is, or if it's going to continue, but then you want to sell, near kind of have that height or at least that stabilization. Because if it's just a quick peak, then, you really got to understand that. And if that quick peaks within 2 years and your plan is to keep it for, 4 to 6, well, then instantly, you've lost that, right? So definitely understanding, especially on the multifamily space that most tend to be in, having those metrics and understanding as the, underwriter, analyst, investor is important. So
yeah. And the one thing you really can't, predict per se when you're investing with somebody is how they're actually going to operate, right? So you may have looked at the feasibility study, you may feel really confident in the ability for the lease up and everything else to happen. But if you get an operator that just quite frankly sits on their hands or, hires outside third party operations that aren't managing the property properly, it's hard to know that up front. But when you can look at it, a year, 2 years, 3 years into the deal, and you can see how they've handled it so far, even if they've seen some hard times because of market conditions, if you can also look at the reporting that they've done and how transparent they've been, that may make you want to be more involved in, investing with that investor.
Investor relations. Yeah. I mean, it's another powerful thing as part of the capital raising process, where it's not just, getting people in and taking care of your investors, but it's also informing your investors. So that way they can make the best decisions. And certainly through this, they can kind of do that. One, big question I have is on this idea of timeline or time of year. From what you know right now, does it matter when investors are starting to talk to people on the secondary market? Are there typically better times of year than not? What sort of maybe trends or maybe things should people think about when they're approaching this to add to their portfolio?
Yeah, I don't know that there's anything there as far as trends on time of the year. Like I said, we have already run into it where certain GPs are only going to make those transfers on a quarterly basis. So that's something to think about. Is you may get into negotiation and lock in a deal, but you can't transfer it for another 2 months, or you may get the deal and then miss the timeline and you have to wait an additional quarter before you can make that transfer. So that's the only thing that I've seen as of so far. I mean, I think you always come to that fourth quarter scenario where people are needing to allocate capital for one reason or another. Oftentimes tax reasons, sometimes just for, planning for the future year. And so I think the fourth quarter is a great time. People always think that the public perception is that the fourth quarter is when business slows down. But for as long as I've been in real estate, the fourth quarter is when a lot of activity happens and there's a lot of movement because people are needing to make decisions. They're looking to launch into a new aspect of their portfolio, or they just have those tax reasons. And quite frankly, most of us would rather put that money to work for ourselves rather than giving it to the government.
Yeah, and we're certainly see that in the oil and gas space, and certainly for those investing in real estate for tax reasons. Absolutely agree. And at some point, it's just like human psychology. It's kind of like, hey, we took the summer off, we came back, kids are in school, we're now operational. All right, let's start things. And as you have conversations and meet people, then we slowly get into October, and then the holidays, all this stuff. Like it just sort of naturally sort of drags into it. So this has been incredible. We'll definitely put some ways and places for people to contact you, as well as just the company overall as it pertains. And through this idea of like the investor's guide to joy, and we invest in the secondary market, what would you put as a like quote or a mindset perspective or a piece of advice or something like that really comes to you as either like from a personal standpoint that's really resonated with you, or maybe even your family, or even then to these investors that you would share and kind of recommend?
Yeah, so I would say go where you are valued, right? I'm in a stage in my life where I don't chase anything that's not chasing me. That goes for relationships, that goes for business opportunities. If somebody doesn't really want and value you, what are you doing there, right? And some of the hardest times I've had in my life was when I was pursuing something that wasn't pursuing me back. So think about this, I guess, to not try to ramble on too much about it, but there's been times in my life where I've really, it's about too much opportunity, right? Not necessarily lack of opportunity. And so sometimes you push on the opportunities that resonate with you most. And then the ones that are the easiest to move are most likely the places where you should be placing your attention.
And to your point, you kind of alluded to this, the things that like pull you like, hey, we're going here, let's go. And you're like, oh, okay, right. Granted, yes, it aligns with your values and your investment thesis or, these kind of stuff. But assuming that, no, that's an incredible reminder, especially in this kind of market, in this investment, and just even personally too. So Christion, I want to thank you so much for coming on. I'm so excited for this, and I know you are too, and look forward to having you on again to talk about capital in the future.
All right, sounds great, Paul. I appreciate the time.
Yeah, thank you. Hey, one last thing before you go. I wanted to share my mission while on this earth, and it's to help educate investors about different opportunities, share mindset tips on how to change our perspective, and different things to really experience more joy in our lives. If this resonates with you at all and you enjoyed this episode, please share it with friends and others to help grow the community around the Investor's Guide to Joy. Leaving a 5-star review also helps grow the show and get connected to more people and share our experiences along the way. Thanks so much for joining, and can't wait for you to listen to the next episode.